Hey guys, how you doing? It's good to see you guys. See that you're chiming in. We're going to be starting here in a few minutes. You're here at Delta Flight 2742. We're heading to Italy, and you're going to get a great report here from the captain of the captain's chair for third quarter state of the market and looking into the future. I'm half blind with these sunglasses on, but I'm here and I see some blue skies. It's cold this morning here in Central Florida, but I'm excited to be with you guys. So I'm going to give it 1 or 2 more minutes for a few folks to chime in, and we're going to kick off our time together. So thanks for being with us, and excited to share some really good information with all y'all. Give it about 2 more minutes, and we will kick off. Tim, thank you for your note. Yeah, we got some great lunch for you guys served up. It's devil eggs and champagne. So hopefully you're sitting up front and you'll get an extra portion of devil eggs and champagne as we are taking off and lifting off. Good to see you, Robin. Thanks for joining us as well. And I think we're about ready to get going here. So let me just see who else has joined us. All right. Well, welcome. It's so great to be with you guys. If you don't mind, I'm going to take my sunglasses off so I can see a lick. But great to be with you guys. It's Captain Chair time, and I got a lot of good things to share with you. So as we normally do this time together, we will be here for about, say, 30, 35 minutes. I want to give you a quick update of where things are, where's it been year to date. I think a lot of the information is probably something that you've heard before, but for those who don't look too much at the markets, I'm going to be talking a little bit more with you about that, and then a little bit more about the future. What do we see coming towards the end of this quarter as well as next year? Probably more about what's happening next year. And then I want to share a few things, updates from the practice and how things are going at the moment here at the Life Wealth Group. And we certainly have a new team member I want to introduce you guys to. So as we get going, you are free to write any questions in the chat bar. Feel free to please put your questions in there. I like to let them just pile up in there, and then after our time together, we will turn to your questions and be able to answer them one by one. So thanks for being with us here today. So as we get going, this always makes the lawyers very, very happy. The disclosures, AE Wealth Management is who we work with, and so on. So there's the disclosures. Now the lawyers are happy. So as you all know, the theme here is, as we look at the end of the third quarter, markets were down pretty strong, right? So S&P is down about 25%. NASDAQ is down more like 32%. Dow Jones is down about 18, 19%. So this is as at the end of third quarter. We had a nice little bump here in the beginning of November, mostly due to how the markets are speculating about what the Fed's going to do about interest rates. So this year's big theme is the year of increasing interest rates. And we still are seeing a little bit of bumping in the markets at the moment due to what will the Fed do next? Will interest rates increase or not? But we'll talk a little bit more about that. Even the Russell 3000, this is just mean 3,000 companies instead of 500 companies are obviously down. Most of your indexes is down. I looked at this with one of our advisors this year. The only area in the stock market that is positive this year is commodities. And commodities are things like, gold, silver, oil, pork bellies, corn, all those kinds of classes of assets. Now, something to know about that is that this is the year in which it was up 25%, but in the last 10 years, commodities has averaged actually 0%. So that's the 10-year average of commodities. And again, very, very few people would have invested in commodities. After the second quarter, it was up about 50%, and then it went down by 30%. So also very, very volatile. What is surprising for most people is that their bond portfolios, which typically were the areas that we've used to reduce risk, is also down by about 13 to 15% for the year. And that mostly is due to interest rates. The rate at which interest rates were increasing, bond pricing is going down. So that which we thought would be a good counter, most people traditionally think is a good counter, did not turn out to be a good counter. But thank goodness that we've used other asset classes, other types of strategies like equity indexing in structured notes, as well as in equity index annuity contracts that provided much better downside protection this year. So the best way that we prepared you all for a year like this year is the way we've been planning all along, and continue to plan for you. So enough down charts. So you should know that we're not technically in a recession anymore, right? And even when we were technically in a recession, you heard me say a lot of times that, a lot of economists don't think we're in a recession. And so what is a technical recession or not? It's whether or not you are 2 quarters in a row, your gross domestic product or output as an economy is negative. Well, the third quarter, the gross domestic product number came in at 2.6%. So technically, we're not in a recession anymore. But we're all kind of feeling like gut is something cooking here next year. So we'll talk a little bit more about that. The factors that are causing the market volatility has a lot to do with interest rates. It also has to do with a signal, a kind of a death signal that's indicating a recession. And that is when the 2-year Treasury rate is higher than the 10-year Treasury rate. And so at the moment, the 2-year Treasury rate is, as of yesterday, around about 4.6%. So we call that an inverse yield curve. That's the formal name. Now, all that means it is a very definitive signal that a recession is upon us or is going to come to us pretty soon. And we've been here for the last year, where short-term interest rates are high now. We like it for our money market accounts, right? So those are about 3.2, 3.3% at this point in time. And as interest rates increase, it's the one place where we like to see increases, interest rates is in those short-term maturities. Another big issue, obviously, is where inflation is. I've got a slide here to show you where it's been, where it is at the moment. It's trending beautifully for us. But another big factor, too, that's causing the market volatility has a lot to do with consumer confidence. I want to talk with you a little bit more about what does that look like, as well as the average savings rate that we're seeing at the moment from people, and how much cash they have and how much credit card debt is starting to increase. Those are all different factors that influences it. But here's consumer confidence for you. So there's an index that is the University of Michigan, measures what we call consumer sentiment. It's really how positive people are in general. And in September 2021, that number was 72.8%. I think people were still flush with a lot of cash in their accounts, getting a lot of cash incentives, right, from the government. And September this year, we're down to 59.5, which is a pretty strong indication that most people are starting to feel in their pocketbook what inflation looks like and really feels like, right? We all felt it very much at the pump. Now we're starting to feel it a little bit more in our retail stores. We feel it in our restaurants, right? I mean, hey, you got to feel it, right? It's still very, very high. So consumer confidence is like the reason this is important is that the U.S. economy drives on consumerism in the United States. That is the freedom people feel in their pocketbook to go have a great Christmas season or to go eat out a lot. Last night I went gun shooting with my kids at the gun range, and afterwards we went to Miller Ale House. And I got to tell you, it was a 30-minute wait to get a table. And it just appears sometimes people are still spending like crazy. So we called over to Longhorn Steakhouse, and lo and behold, we could just be seated immediately there. So I don't know Sometimes you go to the mall and you go like, is anybody sensing a recession? And sometimes you go and you see that certain kinds of restaurants are starting to seal and feel it. So anyhow, it's coming. We all know it's coming. Um, Another factor here too is like, where's unemployment? And the reason that a lot of economists have said, hey, we're not really in a recession yet, is because we saw unemployment rates being so low, 3.7%. And this is a period of time where good news was bad news and bad news was good news. And what that meant basically to the Fed is the lower the unemployment rate is, the more liberty they felt to increase interest rates because the economy can handle that. So that's when good news turned into bad news. So I know it's confusing. I'm just a pilot. I just want to fly the plane, right? So, but this is how we try to navigate through the markets and through reading the tea leaves. I mean, you got to figure out what the Fed is thinking these days, and how what they're interpreting is going to be happening. So still, we have a lot of jobs openings, 11.2 million job openings, right? 2 job openings for every 1 person looking for a job, still very, very high. We started to see now my countryman, Elon, right? I'm going to get ticked off by the people at Twitter, people thinking that essentially he's letting the executives go who is against him in the negotiations. I don't think that's the only reason. I think the guy is pretty smart. He's South African. He's got to be smart, right? Come on. I think he's preparing for what we're seeing, right? And you could see other companies, like other tech-based companies, are starting to lay off people right now. They're getting ready. They're getting ready. So the tech sector is kind of indicating that for us as a beginning spot. What's quite interesting is the housing market. And what's interesting about this in Central Florida especially is like, when does house pricing come down? Like, I'm pretty interested. I'm in a rental house, right? I sold my house too early. I'm like, I can't wait for this housing market to come down, right? But I've been watching it like a hawk. And what I'm seeing is that it's been stubborn. It's been very, very stubborn. Nationally, home prices is down for the first month, about 5.6%. But, I'm pretty cued in with realtors and closing agents and real estate attorneys. But we've seen that the level of closings have absolutely just plummeted. Tremendous amount of reduction in closings happening. We see with mortgage brokers, their applications have plummeted like 40%, right? 7.25% is what the 30-year interest rate used to look like. I think it came down nicely. It's about 6.25, 6.5. If you want to get a 30-year mortgage, my goodness, it's 3 times as much as it used to be, maybe as much as a year ago. So the housing market here in Central Florida has been stubborn because I think we get a lot of influx still from northern money. But nationally, we're starting to see the housing market also retracting in its prices. Interesting, I was at a faith-based CEO roundtable called C12 that I'm a part of yesterday, and the guy next to me was a real estate attorney, and he showed me the MLS, and he showed me basically the amount of homes on the MLS has significantly increased, and the amount of days the houses on the market in Lake and Orange County is increasing. And we're starting to see, even here, prices are starting to come down a little bit. So that's the housing market. Transportation, I saw, we used to having now to have to go buy a new car and pay more than invoice, right? That hasn't happened ever for me to be in the United States, right? About 27 years I've been here, never had to pay more than invoice. And we're starting to see that used car sales is coming down. Used cars prices is coming down a little bit, but again, stubborn until only last month. But transportation costs in general have been up like crazy. Here at the airlines, I can tell you, we've been taking advantage of all you all traveling like you are traveling. Like, you guys come out of COVID, we need the money, right? The airlines have just been, I don't know how you feel, but every time I buy a plane ticket, I'm like, hey, gas didn't go up that much at the airlines. And we know the airlines are taking advantage of our desire to travel, catch up a little bit from their 2 years that they were hardly flying people around. But nevertheless, as a pilot, I'm kind of happy about that, right? All right. So what else is happening here? You can kind of see the inflation rates. You can see very nicely how inflation has been curving. All right. Today, we're at 7.7%. 7.7%. So you can see that the Fed's increase and the rated increase is helping some. All right. A big part of what I think would help that too is what consumers are going to do with the cash in their pockets. But rising interest rates, right? So we've risen another 75 basis points. So the Fed meets one more time before now and the end of the year, and the speculation on the street is anything from 0.25 to 0.5. Now that's a little bit better, because the last time the Fed raised interest rates, the speculation was as high as 0.75% increase here in December. But it looks more like 0.25 to 0.5 for the last increase. But today, what the Fed's going to do is probably one of the biggest speculations about what happens in the markets. The moment somebody figures the Fed's going to not increase as much, the markets jump. But I think it's futile, honestly. Midterm elections, right? So we know we have a split government at this point in time. This is good for the markets, because the markets know that, hey, we're not going to see much more government spending on huge new bills passing through. That's the hope, at least. We're always going to get vetoed, but the hope is that major government spending is not going to be passed. Laws like that, new laws. So we'll still see how that plays out. But the fact that the markets know now what's happened in midterm elections is also a little bit more. Known knowledge is better for the markets than non-known knowledge. All right, so what do I do with this information, Hilgardt? I think we get back to basics. You heard me say that the last time. It's like, hey, we think we get back to basics. What does that mean? I think we just need to be thinking about what we're doing personally with cash flow, cash reserves. Spend less than you earn. Hey, avoid the use of debt. Don't do what everybody else is doing, raking up credit card debt, right? Be smart about that. Make sure you get liquid cash available. Don't know when this recession that's coming next year, the real one is coming next year, exactly when that's going to happen and how long that's going to last. It'd be smart to be smart, right? Think through, maybe it's not the international trips, maybe it's just national trips, right? Be conservative in the way you look at things, right? For my wife and I, we started thinking about when we buy our new home, how quick are we going to, as an example, make a priority to be out of debt, right? Today, when you buy a house at 6.5 or 7% interest, boy, that gets your attention. So getting back to basics is something that's prudent. It makes sense. Now, our federal government, okay, we'll let that be. But as individuals, let's be prudent about what we're looking for. I tell you, as a captain, strap in your seat. We're going to have volatility. I suspect next year we're going to have more downward pressure. We are positioned in our portfolios to position for yield. We're positioning for yield. Basically, our yield portfolios, our dividend-paying portfolios, they are defensive and they're positioned to produce income, dividend income, interest income. We use alternative asset classes that's not in the stock and the bond market to produce income for us as well. So we're doing that. We're looking a lot at how can we protect downside. I'll tell you that we have about 85% of our weighting on having a negative year next year, 15 to be on the positive side. We've also hired a consultant that is a certified financial analyst. That's the designation for portfolio manager. So we've hired a Charles is his name, to join our team, to give us more insights, to help us look more closer to what we are doing. So we are on the defensive side. That's what I anticipate for next year. And I want to share that with you so you know that we're not necessarily expecting a good year. We might have some short-term turn, and then I suspect we can have some more downside pressure. The theme this year is high interest rates. Next year, it's about corporate earnings. And it's going to be how are companies going to endure when the consumer confidence goes down, when their expenses are still going up. What are corporate earnings going to look like? And what the expectation is that it will take a hit. And then when you look at this, what influences the stock market too is what we call a multiple of earnings, a multiple of earnings. And when earnings are down, The stock market has to respond. And remember, the stock market is trying to be 6 months ahead. So here's my thoughts. What I'm reading all around is that the real recession might start as early as January of next year. Most probably around about the third quarter of next year. Could be delayed as much as January 1 of 2024. The amount of time it's going to take for us to work through the recession, nobody knows. Nobody knows. But I will tell you this. I could see statistically, most of the times, the market is trying to be, like I said, 6 months ahead. And when the market is starting to see that we're through this recession, that we're probably 6 months from coming out, you'll see the stock market respond very aggressively. It turns around very sharply. And because of that, we are still in the suspension. We don't want to go to cash, right? We don't want to miss that timing when that happens. There might be a few false indications towards that, but we need to be prudent. It's that way. That's why planning has worked so well for us, because we can identify the whole period we have in our equities and our bond positions for when you need income to come out of your lives. If we're all enduring a negative year next year, but we only need this capital to come out in 7, 8 years, then you'll see us not making major radical moves. We'd be smart to be able to hang in there on the equity positions that we can hang in there on, right? Because we know in your plan, we only need that capital in 7, 8, 9 years. And I think if you speak to most economists today, you'll hear that, hey, I think we'll get out of recession within the next 3 years. Nobody can dial that in for you perfectly, but we probably will be out of recession in the next 3 years. That's why you'll see us talk about leaving equity positions the way they kind of are. Okay, I hope that makes sense to you. And if it doesn't make sense to you, feel free to reach out to us and connect with us on a one-on-one basis. We still want to apply everything I'm saying to you today to your unique situation, right? Because everybody is different. All right. So I'm excited to transition now and just let you know a little bit about what's happening at the Life Wealth Group. We had a new member join our team. This is Louis Pinto. I want to introduce Louis to you. Louis is a great guy, great addition to our team. We see great potential in Louis. And we see Louis actually captaining. Hey, he's another captaining our financial planning team. But he was born in Colombia. I guess I like guys that were born outside the United States. I like the ones that's born here too, right? Hilton is still very much part of our planning team, and so Joe Contanelli. So love these guys. They're doing phenomenal. I can just tell you, these whippersnappers, they work faster than this old guy does. So I'm happy to have them in my planning department. Guy likes motorcycles. I like them too, and outdoors. And he's been an advisor for quite some time. I was able to snatch him from Merrill, and looking forward to working with Louis as we build out our planning team. Then want to tell you guys about something cool that's coming up. I know all of you like our volunteer days. We're doing them on a quarterly basis. And we're doing a toy drive for Nathaniel's Hope. So please bring your toys in when you come and see us. You can scan this QR code to get more information about the toy drive. But as a team, we're all going to do a volunteer day. And I believe this one is the last day of my working day for the year. And I believe that is, I think it's about the 18th or 19th. But you'll see of December. So you'll see the invites. Come and join us. This is a fantastic event to pack gifts that have been given into beautiful Christmas bags that will go out to families that cannot afford Christmas. It's a very rewarding event. We'd love for you to be part of that with us. Stay in tune to the captain. The captain's going to be talking to you a lot. Okay, I'm going to do these every 2-week videos, and I'm going to share with you what's going on in the world, what all this craziness looks like, and what's really between the lines of what you hear on the news and the TV. Try to switch those TV knobs down if you can. The noise is pretty loud right now and can be very confusing. You'll still see a lot of people taking advantage of this. I mean, the guys that are promoting physical gold through the roof, right? Just be smart. And if you want to have a one-on-one with us, come in and have a one-on-one with us. Schedule 15-minute conversations with us, and we can help you understand the context in which we are in and what that means to you very specifically. If you like this video, please feel free to forward it to your friends. We would love to be of help to your friends. in years like this, we tend to grow, and a lot of people are looking at their wealth and saying, maybe I need somebody that can help. There's the context I need to help us to navigate through this. So we would love to help anybody you care about enough to help. And so please use our material to share it with others. I'm excited about next year, folks. I'm developing a lot of great workshops for you, by the way, around conversations about finances, family, faith, and finishing strong. And I just got a fantastic content about how you could share stewardship principles with your children and grandchildren at all ages. And so look out for some cool workshops we're going to be doing here at the airport in the back office, right? Please come in for those. And for those who are that we serve in other states, we will be recording those workshops for you as well. So they could be of help to you. All right. Well, I thank you so much for listening to this talking head. I'm going to take the hat off now. I'm going to put it on autopilot. I'm going to go to your questions and see how I can answer those questions for all of you. All right. So let's see here. I got some real good questions. So Kathy, thanks for the question. With the strength of commodities, will you be adjusting our investments? So Charles Freeman is our new portfolio manager that we've hired as part of our internal team. And he's analyzed this to nth degree. He has access to a Bloomberg terminal, which is a special computer. And it's given us a lot of really good insights to be able to figure out how we do that. So we're doing that inside of the Life Wealth portfolios as well. You see that our other money managers that we have in the lineup are also preparing for down as well. And especially those that do that, those are the ones that we like, because that's where the general consensus is in our world. People are worried about the dollar, right, because of inflation. But I will say, if you still look at the dollar, how strong it is to the international currencies, I mean, it's the strongest, right? I'll be traveling here in the next 2 months over to Europe. Super excited to see the dollar stronger than the euro. First time I think I've traveled overseas where that's the case. So there is impending or fearfulness about how the dollar might be depreciating against other currencies. But at the moment, when bad things happen, people are still running to the dollar. All right, let me see if I can answer another one. Feel free to type in your questions. If you don't like my answers, tell me so, and I'm happy to go a little bit deeper with you on it. Let's see here. Okay, I don't see any more questions from all you all. So with that, then, I thank you guys for trusting us and enabling us to be able to work with you. It's been a really difficult year, I'll be honest, going through all this volatility. My accounts are down as well. I have felt the impact myself, and so has our team. So we're with you. We're with you through some difficulty. This is tough times. But I think if we implement conservative planning, if we prepare ourselves, if we understand the context of where our money is and how it fits into our retirement plans and how far we are, we can make great decisions together. So we really want to thank you for that opportunity to partner with you, from our family to your family. Really, really appreciate that, and look forward to working with you in a difficult year next year. But we are here for you. We're going to walk through it with you. So have a great Thanksgiving week. I honestly just said to clients, I said, there's two things amazing for me about the American culture that I think is just phenomenal: Thanksgiving and family reunions. And I think it's fantastic. So enjoy your family. Be thinking about what you could be thankful for. I know in difficult times, gratitude is a wonderful antidote to everything else crazy that's going on around us. Thanks, guys, for joining us. Be blessed. Have a great week. Bundle up if you're in Central Florida and celebrate the cooler weather. Great to be with you.